All right, hello everyone, and welcome to our latest ALTA Insights webinar. I'm Jeremy Yohe, ALTA's Vice President of Communications, and today we've got a wonderful presentation lined up that we'll dig into the different types of payment rails, their impact on state good fund laws, and share the many resources that are available to help you evaluate what payment methods are appropriate for real estate transactions that you may be handling. Definitely a lot of interest in this. We had nearly 700 people register for today's webinar, so thank you for taking some time and learning about modern payment rails. Today's webinar is being recorded. You'll get an email with a link to the recording tomorrow, and you can always access all of our webinar recordings at alta.org/webinars. That's alta.org/webinars. In the meantime, you can download a PDF of the presentation in the handout section, and there's several resources that the panelists will talk about in the webinar today. If you have any questions, please submit them through the questions box. We'll hold some time for Q&A at the presentation. Don't hold me totally to that. We have lots of content, but hopefully, we address any of your concerns, and you can always follow up after the presentation. Today's webinar does offer CE and CLE credit for many states. Credit's only available for those attending the live presentation, and our platform does track attendance. To meet compliance, we'll have a couple of poll questions throughout the webinar, so make sure you're paying attention and no multitasking out there. At the end of the presentation, I'll post a link in the chat box that you can provide information needed for us to report your credits. And with the link, then you'll need to log on to the ALTA website. Once logged in, you'll need to add or update your national producer number and credentials in the states where you're requesting credit. Check the attendance certification checkbox and click request credits. I know that's a lot of information there. Send questions to email education@alta.org. All right, that was a lot to get through here. So I do need to thank Qualia for sponsoring today's webinar, and we have a short message from Qualia.
Qualia's unified digital closing platform is used by thousands of title and escrow companies to provide simple, secure closing experiences, fully integrated workflows, accounting and reporting products, and a robust system of custom integrations power the connectivity your team and partners need and deliver the differentiated customer experience your clients expect. Qualia innovates alongside you. Together, we can proudly transform how homes are bought and sold.
Okay, all right, thank you, Qualia, for that message. All right, let me make Michael the presenter here. All right, sorry for the clunkiness. Always have to hand off the baton here. I'd like to introduce today's speakers. First, we have Chris Holtzman. Chris is Vice President of Corporate Underwriting for First American Title Insurance Company. We also have Michael O'Neill. Michael is also Corporate Underwriting for First American Title. And also joining us is Mickey Vandenberg. Mickey is Vice President of Escrow Operations for Stewart Title. All three are definitely very involved with ALTA engagement groups and looking at how transactions can be improved through digital means. And Michael, thanks for modifying here. I handed it off to you before I got through all my slides that we just said I would do. One more thing to note before we get into the presentation, we've got to share the obligatory slide here to mention that the presentation is not meant to be legal advice. You should consult your attorney before addressing any specific questions you may have and for any guidance. So Michael, with that, I'll turn it over to you to get us into the content.
Thanks, Jeremy. We're going to kick it off with Mickey and Chris talking about the ALTA Good Funds project.
Thanks, Michael. Our industry has been hearing a lot about modern payment rails over the past few years, And a lot of this conversation is being driven by two real-time or instant payment rails that have been recently launched. These new payment options constitute the first truly new payment rails in almost 50 years. At ALTA One in San Diego back in 2021, we heard from representatives from the clearinghouse about RTP, or Real-Time Payments Network, which is run by a consortium of some of the nation's largest bank and launched originally in 2016. And then just this past summer, the Federal Reserve launched the FedNow instant payment service, which offers a similar payment service. Of course, it's not just new technology that's driving this discussion. As all of you know, wire fraud continues to rank as one of the most serious threats to our industry. Beyond the headlines, we've heard from you in survey after survey that this is one of the most serious threats that each of you face in your businesses. As a result, this past year, ALTA Board of Governors made addressing modern payment rails a strategic priority for our association. Chris?
Well said. Well said, Mickey. The ALTA Good Funds Work Group started meeting over 2 years ago at this point with the goal of developing model legislation that would enable RTP and FedNow. But after months of work, we realized there was quite a lot that we really as an entire industry didn't know. We realized that we needed help from outside counsel. So last spring, we went through a significant RFP process and ultimately chose the law firm Morgan Lewis to help with a multi-stage project. We learned a lot as a result, which you're going to hear more about today. The project was broken out into 3 main phases. First, the Morgan Lewis team created an extensive comparison chart to enable our industry to see the answers to common questions about wire transfers, RTP, FedNow, and ACH payments. This comparative legal research then became the basis of a use case document that shows how these different payment rails play out in the real world of real estate settlements. Second, the team conducted significant research on existing state good funds laws to see which ones might already permit real-time payments. And finally, the team helped us draft model legislation for the enactment or adoption by states looking to enable the use of real-time of modern payment rails in real estate transactions. In the remainder of this presentation, we're going to go through each of these project steps in more detail. And for that, I'm going to kick things back over to Michael.
Thanks, Chris and Mickey, for kicking us off. And I apologize in advance for a slight delay audio between my video and the sound. But in any event, let's begin by taking a high-level tour of these modern payment rails that Chris just talked about and modern payment systems. So to begin, what is a payment rail? You may be asking yourself. Well, if you'd asked that question to anyone about 50 years ago, they would have looked at you and scratched their heads, had no idea what you're talking about. That's because really the only widespread used payment system besides cash back then was the check collection system. There were wire transfers between large banks, but it was usually done by private contract, and there wasn't really a governing body of law around that yet. You fast forward to today, and things look very different. So to understand a payment rail, you first have to understand what is a payment. So Chris, if I want to pay you $10, a couple of ways I could go about doing that, right? I could hand you a $10 bill. That is a chattel. It's a piece of personal property, and the normal chattel rules apply, delivery and acceptance, etc. There's some special rules around money about the transfer of title, free of defenses and legal tender, but otherwise, a piece of personal property. However, I could also send you money from my bank account. And the question is, why are these the same things? From a lawyer standpoint, not an economist standpoint, but from a lawyer standpoint, money is a medium of exchange. And there's basically 2 types of money. There's central bank money, bank notes, Federal Reserve notes, and commercial bank money. That's the digits in your bank account. These 2 types of money are freely convertible between each other. So just as I can deposit money with my bank, cash, and then it shows up in my bank account, my bank can likewise deposit excess cash that it has with the Federal Reserve, and it shows up in its master account, or it can draw down and get newly, freshly minted coins and printed notes. This process is what makes $1 have a singular meaning of $1, whether I'm paying you with a dollar bill or paying you through bank credits. Payment rails are how commercial bank money, that's that middle bar there you see on your screen, is transferred between people's bank accounts. The word transfer is a bit of a misnomer because in legal terms, what's actually happening is somehow I have to convince my bank to reduce by $10 the amount of debt that it owes me. And I've got to convince Chris's bank to increase by $10 the amount of debt that it owes Chris at the same time, corresponding amount. And that has to constitute a payment from me to Chris. And it turns out how this actually happens is rather complicated. There are basically two models for transferring money between bank accounts. You can do a credit transfer or a debit transfer. Credit transfers are sometimes called push payments, and debit transfers are also known as full payments. In both types of payments, the direction of the funds transfer is the same, going from my account to Chris's. Ultimately, it goes through like a clearinghouse, the Federal Reserve, some consortium to get the money between the banks. But in a credit transfer, I begin the process, I initiate the process by instructing my bank to pay Chris's bank, pay Chris at Chris's bank. With a debit transfer, the reverse is the case. The information and the funds flow in opposite directions. So the easiest way to think about this is a check. If I'm paying someone via check, that's a negotiable instrument where I instruct my bank to pay a person. But you begin the collection process by giving the check to the payee, and then the check or an image of the check winds coming all the way back to my bank, travels backwards through the process. So the difference between these two models is really fundamental. Most obviously, in a debit transfer system, the system itself has to inherently rely upon provisional payments until the instructions or the order makes its way all the way back to the original bank. But in a credit transfer, no such provisional payments are necessary. And moreover, there's entirely different bodies of law that apply to these different payment systems. So on this slide, we're going to look at all the existing payment rails. These are what we're going to talk about today. And that's it. This slide shows them all. We're going to talk about wire transfers and real-time payments. Both of these are credit transfer systems. We're also going to talk about ACH a bit. ACH operates as either debit or credit. And then finally, the traditional check collection system is still available today and widely used, particularly business-to-business payments, and that is a debit transfer system. So let's get started with a discussion of wires and the body of law that governs them, and that is largely found in UCC Article 4A. And the following discussion is going to be rather complicated, so I apologize in advance, but these rules are really fundamental to our industry, how our industry uses payment rails. And these rules also apply directly, not just to wires, but also to FedNow, RTP, and ACH in non-consumer credit context. So knowing some of the basics of these rules is very useful for our industry. So first, what exactly is a wire transfer? The term wire transfer is really a colloquialism. It doesn't have a precise legal meaning, certainly under state law, and that creates some ambiguities we're going to talk about in a bit. But the two payment rails that everyone agrees is a wire transfer system are FedNow, or FedWire rather, and CHIPS. FedWire fund service is operated by the Federal Reserve banks, as you know. The CHIPS service is a consortium of private banks operated by the clearinghouse. Sometimes people call these wholesale wires or commercial wires. In other words, they're focused primarily on non-consumer payments. Although, of course, we all know that consumers can certainly send a wire. They do so every day in real estate transactions. But that's not the main focus for these systems. Credit transfer systems are also known as real-time gross settlement systems. And that means that payments are handled one at a time in a gross basis. Each payment is handled by the bank separately. And that's very different from some other payment systems where payments are batched, collected, and then netted against each other and handled on sort of periodic settlements. When you're sending a wire, your banks are processing the wires one at a time. These systems move truly massive amounts of money every day. FedWire sends over 4 trillion averages every banking day, CHIPS close to 2 trillion every banking day. So for some perspective, the entire GDP of Italy is just slightly over $2 trillion. So that gives you some flavor of how massive the amounts of money are that we're talking about here. FedWire has about 5,000 US banks participating. CHIPS has a far smaller number of banks, a few dozen that are mainly foreign U.S. domestic branches of foreign banks, and they handle mainly cross-border payment flows. We primarily, of course, use FedWire for real estate, but chips could be used, for example, in like a commercial context with international investors or lenders. So both FedWire and chips are governed by UCC Article 4A, as I said earlier. And this, of course, is part of the Uniform Commercial Code. It's also been adopted as a matter of federal law, rather, under Reg J, as it applies to FedWire. Now, Article 4A is a very interesting law. It was drafted in the late 1980s, really on a blank slate. One of the primary goals of the drafters was to create certainty and finality in payments. And so this crazy spider web looking diagram that I drew, it's intended to show how this works from a legal standpoint. All of these different things happen at the same time, instantly. The magical moment in a wire is acceptance by the beneficiary's bank. And the beneficiary's bank can accept a wire in basically one of two ways. You can push one of those green buttons, if you think, to start the process. First, it could actually get paid in its account, for example, by the Federal Reserve crediting its account. Or it could place money in its client's account, beneficiary's account, or give notice that the beneficiary can spend the money. If it does either of those things, it has accepted the wire. In other words, if I put the money in the beneficiary's account before I get paid, that doesn't matter. And from a bank standpoint, I've already accepted the wire. Likewise, the instant that happens, it means that the originator of the wire has, by operation of law, paid the beneficiary of the wire and also discharged any debt. Moreover, you see this blue box in the far right. That's the receiver finality rule. If the bank puts money in its customer's account in completion of a wire, it cannot make that payment provisional. That payment must be final as a matter of law. And again, all of these things happen simultaneously under UCC Article 4A. Moreover, not only is the credit to your account always final if you get a wire, not provisional, the person who sent you the wire has no right to claw it back or to reverse it under Article 4A. There is a slight caveat here to point out, which is that your bank might be able to agree to cancel a completed wire under very limited circumstances, but this would be highly unusual. First of all, the reasons for which it can agree are very narrow. For example, it was a duplicate payment or too much money was sent. Moreover, even if it were to agree, the sender of the wire would have to be entitled to it under the law of restitution and mistake. And your bank need not agree to a request to cancel. And in fact, there's a strong incentive for your bank not to agree to a cancellation request. If your bank reverses or cancels a wire that you've received over your objection, that could embroil your bank in a lawsuit. On the flip side, if it simply refuses to agree to cancel and it tells the sender of the wire, you have to take this up directly with the person you paid, then the bank gets to stand outside of that lawsuit. And in other words, the payment itself under Article 4A is truly final. So I mentioned that there are, if you're going to reverse a wire, there has to be, the recipient must have some sort of entitlement to the funds or not have an entitlement to the funds under the law of mistake and restitution for that to happen. There are some defenses that play out in this scenario that are kind of interesting. One is called the bona fide payee defense. Earlier restatement called this the discharge for value rule. There's a great recent example of how this actually plays out in practice. A few years ago, Citibank mistakenly sent almost $1 billion of its own money to creditors of Revlon. Those creditors were not entitled to the money when they received it. They asked for the creditors to send the money back. About half the money came back, but the other half the creditors said, no, we're keeping it under this discharge for value defense. Their argument was upheld by the district court, and they didn't have to send the money back. Now, ultimately, this was reversed by the Second Circuit. They said, no, in this case, the creditors actually had inquiry notice. But you'll notice that Citibank didn't get their money back by trying to cancel the wire under UCC Article 4A. Rather, they had to sue the creditors directly under a theory of unjust enrichment and mistaken payment. The beneficiary's bank was not a party to the lawsuit. and the finality of the wire itself was not an issue. So this is just an interesting example of how final wires really are. So if wires provide strong rules of payment finality, what are some of their downsides? Well, everyone on this webinar probably is well aware of some of the downsides of wires. There are basically 4 major shortcomings, and I'll bucket these. And all of these shortcomings are actually strongly related to the rules of payment finality. You have the problem of fraud or interloper fraud and error in the payment process, and you also have timing and control issues. Wires are intended to be same-day value transfer systems, but you've probably, like me, been sitting in closings plenty of times where the customer says, I've sent the wire, and you're sitting on the receiving end saying, well, I'm waiting for the wire to go through. I have no idea what's causing the delay. No one can tell you why. My bank can't, the customer's bank can't. So what is going on here? Well, that's because, and I apologize for the next few slides, which are slightly gratuitous. I recognize and acknowledge that, but wires can take some time under the applicable rules. I was trying to think of some of the reasons that wires could get delayed, and so I started making a list on these slides, and you could probably think of others as well. But some of the bigger issues include the fact that an intermediary bank, that is a bank that's processing the wire, has no obligation to actually process it. You know, once they do process it, they have to do it expeditiously, but otherwise they don't have to accept it. So it can just sit in the queue. Also, think about the fact that wires are real-time gross settlements. As I said earlier, each wire happens one at a time. What might happen is a bunch of clients might have requested wires out from a particular bank, and it doesn't have enough funds in its master account to cover all the wires. So it may sit there waiting for wires to come in order to fill up its master account and then queue the wires that it's received. From a title company standpoint, we have no idea that this might be happening. Here are some other assorted reasons for delays that I was able to come up with. These are legal reasons for delays. They include things like, the bank can set up processing cutoff times, and even if your bank receives funds, it might not have to make it available to you as a recipient until the next day, depending on timing issues. The bottom line from a timing standpoint is that if someone wants to send wire into escrow for a closing, they should give themselves plenty of time, maybe even a day or two if timing is absolutely critical. This is recognized by one of the leading scholars on wire transfer systems, and also by the drafters of Article 4A itself. Basically, both of these authors warn that if the timing of a payment is critical, sender beware. So let's talk briefly about wire fraud. As I mentioned, the very rules in Article 4A that make wire transfers efficient, with Federal Reserve banks processing trillions of dollars every day, they also wind up placing much of the risk for wire fraud and other errors on the users of the system. On this slide, we see how the loss is allocated in the case of interloper fraud, or just wire fraud, where a fraudster somehow gets you to wire funds to their account or intercepts the wire. The first rule is that if a customer sending a wire or its agent, like an employee, actually authorizes the wire, it bears the risk of loss under Article 4A. For example, if a customer mistakenly wires funds to a fraudster because they were sent wrong wiring instructions, the bank does not bear that risk of loss under 4A. Moreover, even if the wire was not authorized, if the bank uses a commercially reasonable security procedure, which is a question of law for a judge, that doesn't go to a jury under 4A, the customer also bears the risk of loss. This is also the case where the bank offers some security procedure, but the customer selects another one. So for example, if the bank offers multi-factor authentication with some sort of token, physical token to initiate a wire and the customer declines, the customer might bear the risk of loss or wire fraud. And then finally, Article 4A also places the burden of proof on customers to show that it was not, that the error was not a result of insider fraud. So again, all of this simply means that the rules of payment finality and efficiency are not cost-free. They place a significant degree of risk on users of the wire system. This also plays out with errors in the payment process. On this slide, I gave one of the more common examples of what an error in the payment process would be. That would be when the account number does not match the beneficiary's name in the wire. And in that case, the beneficiary's bank is entitled to solely rely on the account number. It can just ignore the beneficiary's name that's been put in the account name of the wire field, even if that name doesn't even closely resemble the name on the actual account. So again, the overarching goal of UCC is efficiency. The beneficiary banks don't have to manually check numbers and match them with account names. But it achieves this efficiency by placing risk of the error on the user of the system. So compare that to the check collection system under Article 3, where under Article 3, if there's a discrepancy between words and numbers on a check, the words control or prevail. It's the opposite under Article 4A. Time for a poll question.
All right, thank you, Michael. For everyone who needs CE/CLE, here's the first poll question. Which UCC article primarily governs wire transfers? So who is paying attention out there, or who knows it? Give you about 5 more seconds. Jeopardy theme song. All right, 93%. We've got Article 4A, Michael. Close
Good
it.
deal.
Turn it back over to you.
All right, still showing my screen? We're good to go?
It is, yep.
Thanks. We're going to kick it over to Mickey and learn about real-time payments now.
Thanks, Michael. So learning about and enabling real-time payments was at the heart of what we at ALTA Good Funds Workgroup wanted to achieve with our project. So we're going to talk more in detail about what these new payment rails are and how they work. Next slide. There we go. So what is a real-time payment? A real-time or instant payment is like a wire transfer, but there are several key differences. As we mentioned at the outset, there are 2 major real-time payment systems in operation today. The first is the RTP network operated by the clearinghouse, and the second, which launched in July of this year actually, is the FedNow service operated by the Federal Reserve. Like a wire, each operates as a real-time gross settlement system. That is, each payment is handled on a one-by-one between participating banks by individual debits and credits to their Federal Reserve master accounts. However, unlike a wire, whereas Michael discussed the processing time can stretch for hours or even days, in a real-time payment, the entire transfer happens instantaneously, within a matter of seconds. Moreover, both RTP and FedNow operate continuously 24/7 every day of the year. There are no wire cutoff times or other windows in which payments must be made. In addition, these systems are intended to be used by both businesses, but also for consumer or peer-to-peer payments. So imagine if we're both sitting at our favorite restaurant, one of us picks up the bill and the other wants to send a payment for half of the bill as reimbursement. If I send you a Venmo or even through PayPal, if the app shows the payment has been processed immediately, it might still take 1 to 3 days to get the money from my bank account to yours. That's because many payment apps run on ACH as the payment rail, and they're subject to those system rules. But if I send you an RTP at the restaurant table, within seconds, the money will actually be sitting in your account and will be withdrawable from your account. The next 2 slides are just to indicate the level of legal research that our Good Funds team and our outside counsel at Morgan Lewis did for our industry. Details of these laws are found in the large comparison chart. As you can see, the laws that govern FedNow are highly complex and include both federal and potentially state law, depending on the issue. Likewise, the RTP system is governed by a complex interplay of federal and state law. Most of the rules for RTP are found in the private system rules, but for any non-consumer payments, RTP is also governed by UCC Article 4A, as Michael mentioned earlier. So while the 2 real-time payment systems share a lot of similar features, it's important to understand that they may be governed by slightly different sets of rules, as we will see shortly. As I mentioned earlier, the first key difference between real-time payments and wire transfers is that the real-time payments results in real-time or instantaneous payments between senders and receivers. This means that final payment doesn't happen within days, hours, or minutes. It literally happens within a matter of seconds. Here we see the relevant provisions of the operating rules and procedures for both RTP and FedNow. These rules largely replicate the rules in UCC Article 4A that we saw earlier. Under both, a sending bank's payment to a receiving bank becomes final the instant it's recorded in the transaction ledger at the Federal Reserve Bank or by the RTP system. Like with wires, this means that payment, including discharge of any underlying debt, happens simultaneously with the posting of the payment transaction between banks. Once the payment shows up as having been processed to the consumer, it is already completed. Again, this literally happens in a matter of seconds. Like with wires governed by Article 4A, once a real-time payment is made, it cannot be reversed except by a voluntary return of the receiving bank. Although under both the RTP and FedNow systems, a sending bank may request the reversal of the payment, and the receiving bank is required to provide some response to that request, but there is no obligation to reverse a completed payment transaction. Here we see the specific references to the rules for both RTP and FedNow that codify this result. And to the extent that the payment was made between non-consumers, the rules in Article 4A limiting the reasons for reversal that Michael covered earlier also still apply. The bottom line is that real-time payments result in payment finality that is nearly equivalent or identical to the finality rules that govern wires under UCC Article 4A. And one of the more important features of the new real-time payment systems is the tools they incorporate to help mitigate payment fraud. So let's discuss some of these features in depth. First, both systems will support a feature known as request for payment. This tool is still being developed and is not yet available for a real estate transaction use case, but when it does, it should be a powerful way to prevent a lot of interloper wire fraud. A request for payment will enable a company, like a title company, to send an invoice or maybe a settlement statement to a customer asking for payment. Since the request comes directly from the business, this greatly reduces the risk that some fraudster will intervene and provide false wiring instructions, or that the consumer will miskey the business account numbers when setting up the payment. In addition, RTP uses the tokenization of users to mask their underlying account numbers. This prevents account information from being inadvertently used or hacked by fraudsters. You may have some experience of tokenization on other popular payment apps like Venmo, which they do not require you to key in the bank account or a routing number of the person that you want to send money to. Of course, both systems require the use of multi-factor authentication to access the payment platform. So significantly for our industry, both payment rails currently have transaction limits or caps on the size of payments that may be made. Real-time payment has recently increased their transaction limit to $1 million, while FedNow launched this summer with a $500,000 limit, although the system is set to $100,000 by default. These caps are intended to limit the amount of money that can be inadvertently sent, but are expected to increase in the future as additional fraud mitigation technologies are deployed. As you're probably thinking, these caps also are going to limit the utility of these payment rails in many real estate transactions. In some markets, many residential property values exceed the $1 million or the $500,000 limit. Another notable feature of FedNow is that it permits dollar limits for specific participants of the systems and also has a negative list for participants who are suspected bad actors. Altogether, these fraud mitigating techniques, while still being developed, hold out the promise for making real-time payments significantly safer than wire transfers are today. And if fraud does happen, at least in the consumer context, the consumer will still have recourse under Regulation E. This federal law, which does not apply to wire transfers today, allocates the risk of loss between consumers and their banks for any unauthorized payments. Of course, this also means that many banks may be reluctant to offer real-time payments without significant technology or other controls in place. Think, for example, the dollar limit that your bank places on you for the use of your ATM card. This is largely a result of Reg E. The existence of this federal law as a backstop for consumers means that participating banks will need to develop additional fraud mitigating tools before real-time payments are widely deployed for consumer use. I am now going to turn the conversation over to Chris, who's going to walk us through the basics of ACH payments.
Thanks, Mickey. So learning more about ACH transfers was one of the key goals of our Good Funds work group. So we made sure to include ACH in the legal research and use cases that our outside counsel, Morgan Lewis, helped us with over the past year. Now, you may or may not have heard about ACH payments, but you most likely have used it before. In fact, ACH is today by far the most popular payment rail by the number of transactions it processes, easily outpacing checks. In this section, we're going to break down ACH. What is it? What is it used for? And how does it compare to wires and real-time payments? So what is an ACH transfer? Well, ACH stands for Automated Clearinghouse. These are electronic payments made over the ACH network governed by the NACHA operating rules, along with other applicable federal and state laws. There are two major ACH network operators, the Federal Reserve Bank's FedACH, and the Electronic Payments Network, EPN, which is privately operated by the clearinghouse. Although FedACH processes most ACH payments, EPN handles nearly half of all commercial ACH payment transactions. ACH can operate as either a credit or a debit transfer system, and the NACHA operating rules provide for some different rules that govern each of those payment types. The main difference between ACH and other payment rails is that it operates on a deferred net settlement system. So what does that mean? That means that ACH processes payments in batches, not individually. So that means that there are certain windows where many payments are collected together and processed in a batch at set times throughout the day. ACH also processes these batches on a net basis, not a gross basis as you have with wire transfers. So each bank debits and credits within the batch are tallied up and then offset against each other. So the actual money that changes hands between banks is only that resulting net position. Whenever ACH transfer involves only non-consumer originators and receivers, ACH is also governed by UCC Article 4A, which Michael touched on earlier. However, all ACH payments are governed by the NACHA operating rules, which I think you could tell from this webinar are very complex. And as I mentioned previously, there are a huge variety of uses of ACH today. So what are these different uses? Well, some of the more common uses are on your screen now. If you get direct deposit for your payroll, that's done by ACH. If your mortgage or utility bill is on automatic bill pay, that's also ACH. The federal government processes nearly all of its vendor payments via the ACH network. And as we touched on before, many of the peer-to-peer payment apps also use ACH as their underlying payment rail. ACH is simply ubiquitous in today's world, but it does pose significant challenges for real estate transactions. So I'm going to set aside ACH debit transfers. I want to focus on what the ACH rules and other governing laws say about credit transfers and the reversal risks involved. Now, this slide shows different timelines for standard ACH credit transfers and same-day ACH payments, which permit same-day value transfers of up to $1 million. The main difference between these two is how far in advance you need to initiate the payment. For a standard ACH credit transfer, you have to initiate payment up to 2 banking days in advance. With same-day ACH, you can obviously initiate it on the same day you want the settlement to occur. But the real key to this chart is the reversal risk under the NACHA rules. The originator of a payment has the right to reverse the payment, or an entry as it's called under the ACH rules, for up to 5 banking days after the settlement date. That means that someone receiving an ACH payment is not free of that reversal risk until the 6th banking day at the very least. Because I'll also add that NACHA rules do excuse delays, so even the 6th banking day is not a hard and fast rule in every case. Now, let's take a closer look at how this reversal risk plays out and how it compares to the risk of payment reversal that we saw under wire transfers under our UCC Article 4A. One key difference between ACH credit transfers and wire transfers is that for ACH credit transfers, the receiving bank has to justify returning a reversing entry under the NACHA rules. Whereas, as we saw earlier, under UCC Article 4A, the beneficiary's bank can simply ignore a cancellation request for a completed wire. This means that the NACHA rules require resolution of disputed payments largely within the payment rail system itself, which could include resulting to arbitration under the ACH rules. Now, if you think about that in the context, all this time, if you did have a dispute, the credit that the receiving bank made to its customer's account is only provisional, it's not final, which means that it could be reversed if the outcome of the dispute resolution process requires a reversal. And even then, if that's appealed or disputed, and even if the reason for the reversal request is ultimately found to be invalid, the recipient of the ACH payment still only has provisional credit to its account, which it could use at its own peril until the legal process fully and finally plays out. For these reasons, ACH provides significantly less certainty on the question of payment finality than do wire transfer systems or real-time payment systems today. I'm going to pass it over to you, Michael. Poll question.
All right, one more poll question here, which is not an example of real-time or instant payments. Give you all a few more seconds. Looks like we got 97% U.S. postal money order, so ding, ding, ding for everyone who picked the third answer. All right, we'll close it and then we'll turn to good funds.
Awesome. Thanks, Jeremy. Thanks, Chris and Mickey, for that detailed overview. We've talked a lot about payment rails and law. Let's talk about good funds now, finally. A major goal of our project was obviously to understand better what changes we might need to make to our existing good funds laws across the states in order to accommodate real-time payments. This required the deeper understanding of the nature and purposes of payment systems that we just went over, but also the nature and purpose of good funds laws themselves. So first, why do we even have good funds laws? You know, as we'll see shortly, in fact, not every state does have a good funds law. Roughly half the states don't. But nonetheless, good funds laws serve important purposes. The most basic thing to keep in mind, however, is that good funds laws govern the conduct of escrow or title agents. They do not govern the payment rails, of course. First, they provide protections to our clients and customers. They provide strong safeguards on the protection of money that's deposited into an escrow account. It also prevents the inadvertent spending of other clients' funds. If one payment's called back that I've already spent, I might have accidentally spent other clients' funds in my escrow account. It's also notable that even in the absence of a good funds law, an escrow agent probably also has other contractual or fiduciary, and if they're a lawyer, possibly even ethical duties for safeguarding client funds. And a good funds law may provide some more specificity for these other duties. Secondly, good funds laws provide systemic protections to our real estate economy. And they do that primarily by protecting the financial stability of escrow agents and by helping to prevent fraud. On this slide, we see some of the major categories of risks that payment finality, that thing we've been talking about all day, is designed to mitigate. And this is why good funds laws are so focused on those payment rails that provide finality. If a payment is only provisional, if it's not final, you have credit risk from both the payor and also the payor's bank. From the payor, there may be insufficient funds in the account, but the payor's bank in extraordinary circumstances may also pose a risk. We saw this play out in the mid to early 1990s when many title agents in the Southeast were affected by a regional mortgage lender that became insolvent and suspended payments after it had issued a number of certified checks for closings. And these didn't clear and they were dishonored. In theory, good funds laws may help prevent this risk. So besides counterparty credit risk, good funds laws also mitigate against other risks of reversal of funds, whether that's based upon an argument that the payee lacked entitlement to the funds. And even if we think more globally, from the perspective of the regulators and architects of these payment systems, payment finality is also an important tool to mitigate systemic risk in our financial system, primarily by providing efficiency and legal certainty in the payment process. Okay, so that's the purpose of good funds laws. What were the results of our research? Here you can see the map of the US, and the states in green are those states that have a good funds law on the books today. That adds up to 29 states plus my hometown of DC. We also found that, and you'll see this particularly clustered up in the Northeast, there are a number of states that impose lender funding requirements for loan transactions, how they have to fund into escrow, but they don't impose those requirements directly on escrow agents for the types of funds, other types of funds they receive into escrow. We spent a considerable amount of time this past year going over each of these laws with a fine-tooth comb with the team at Morgan Lewis, our outside counsel. And what we found is that existing state good funds laws are marked by a considerable degree of ambiguity. They use terms and phrases that don't have precise legal meanings under underlying bodies of law. One of my favorite examples here is the phrase electronic funds transfer, which is almost a perfectly ambiguous phrase. It could either refer to a funds transfer under Article 4A that's made electronically, like a wire, or it could refer to an electronic fund transfer, singular fund, which is a consumer payment governed by Reg E. And the problem is these two categories of payments are mutually exclusive. Does it refer to either of these? Does it refer to both? There's simply no way to tell. This is another example of some of the difficulties we had in construing existing state good funds laws. The NAIC Model Title Insurance Agent Act is the only other good funds model that we found out there to exist. But as you can see here, this model act also has some ambiguities, but also it contains conditions, for example, that no title agent would really be able to determine. How are you supposed to know if a check is finally paid, or that wire is unconditionally received, or that an ACH conformed to the NASA rules? So we try to avoid a lot of this in our model act that our industry put together with Morgan Lewis this past year. And here, by contrast, you see some of the legal terminology that's used under PUCC or federal regulations. So with all this ambiguity, what were the final results of the Morgan Lewis's team's review of these state laws? Well, remember, one of our primary goals was to determine whether RTP and FedNow were permitted under existing state good funds laws. And as a result of a lot of the ambiguity we just discussed, the primary answer was maybe, or it depends. It's hard to say one way or another in many states. In only 6 or 7 states was there a reasonable enough certainty in the language that was used to be able to conclude that RTP and FedNow were likely permitted under state laws. We tried to remove this ambiguity in our model act that we created for the industry with the Morgan Lewis team. So I'm going to kick it back over to Mickey to discuss our new model act.
Thank you, Michael. The final step of our project was drafting a model good funds law that can be used in any state that wants to adopt one. The three of us are now going to wrap up our presentation with an overview of that model that the Morgan Lewis team drafted for our industry. Early on, our good funds work group adopted several basic principles that guided our efforts in crafting an industry model. First, we wanted to enable the use of modern payment rails like RTP and FedNow. And this was both to increase consumer choice, but also to facilitate new anti-fraud technologies that can protect both consumers and title and escrow agents. As we saw earlier, many existing good funds laws are decades old and don't necessarily encompass these new modern payment rails. Second, we also wanted to make sure that we were focused on the new payment rails, that is, methods of transferring commercial bank money or US dollars in bank accounts. We did not want to address cryptocurrencies, credit cards, or other types of non-bank-to-bank money transfers. These other forms of payments carry a number of significant risks and make them inappropriate for model legislation. And these risks are discussed in the FAQ that you can find online or attached, I think, as well. Finally, we wanted to make sure that the conditions to dispersing good funds were appropriate and highly protective of both title companies and their customers. Beyond those broad principles, in drafting the model, we had a number of other more specific goals. For example, we wanted to avoid the ambiguities of many existing laws by creating a simple, easy to use framework, something that could almost be used like a checklist for escrow agents, or even handed to a consumer or regulator for use, for example. Another goal is that you shouldn't have to be an expert in payment law in order to use the model. You shouldn't have to determine the results of interbank processes like final settlement, or need to look up to other bodies of law to understand what's required, like Michael mentioned earlier. Finally, we wanted to avoid the implication that escrow agents must accept payments in the form of good funds just because it appears on the list. So for instance, if a customer walks in with a large bag of cash, or you get a suspicious cashier's check, the model expressly permits escrow agents to set a higher standard of care as a matter of sound business practice, or perhaps because of some other legal duty requirements for higher standards. I'm now going to turn it over to Chris to help explain the scope of our model and what it does and does not cover.
Thanks, Mickey. You know, we thought long and hard about what the appropriate scope of good funds model legislation would be, especially since almost no two existing state statutes were exactly the same. One of the things we determined early on is that a good funds law should cover the receipt of funds into escrow by escrow agents, but not the form of disbursement out of escrow. There are other security and related risks related to escrow disbursements, but these are distinct from the good funds risks of payment finality that we intended to cover. In this respect, we follow the framework and structure of the majority of state good funds laws as they currently exist. We also wanted to focus solely on the real estate transaction context. We may be holding client funds for other reasons, such as long-term or single-party escrows that carry more fact-specific payment risks that couldn't easily be addressed by a single model. We also avoided trying to answer questions that some state laws already cover today. For example, where a bank holding escrows must be located, or whether escrow accounts may be interest-bearing. These questions are covered by other law, and we wanted to leave that undisturbed. Another major issue we eventually had to grapple with was the problem of checks, which, Michael, I'm going to hand it over to you to talk about.
Thanks, Chris. Checks, unfortunately, pose an almost insurmountable problem if you're trying to answer the question, when is a payment by check truly final? There are many, many reasons that a check that you may deposit may not be properly payable. And that means that even if you get a provisional credit after depositing the check, you may face a reversal risk, sometimes days, sometimes even weeks, months, or even years later. Depends on the type of risk we're talking about. Now, some of the biggest problems, like the risk of a counterfeit check, an unauthorized check under UCC Article 4, usually become assumed by the payor's bank relatively quickly after that bank's midnight deadline, the midnight after the banking day that they get the check presented to them. But even this is not a guaranteed rule, since many of the nation's largest banks have opted out of this rule, and they place the risk of a counterfeit or forged check back on the depositor for at least several months. In other words, it's really hard to say when a check ever constitutes good funds, absent perhaps waiting the long limitations periods to run or something crazy like that. I like to say instead perhaps that checks are good enough funds in some circumstances, but that's quite a different thing from being able to say they are absolutely good funds. Also, another problem was that checks, the way they're handled under existing laws today in the states, vary widely. And so for all of these reasons, the language in our model about checks is bracketed. It indicates that this language is optional. Now, that said, we did work really hard to come up with a recommended approach, but we also recognize that the solutions of our model only reflect one possible set of policy choices that could be made with respect to this rather intractable problem that are checks. Chris, why don't you then show how these answers came out in our model?
Great. In this slide and the next one, you'll see the definition of good funds in our industry model. The first thing you'll notice is that we tried very hard to be clear in our choice of terminology. Whenever we explained what form of payments are acceptable, like a wire transfer or a real-time payment, we followed that up by indicating what the underlying payment rail is, meant by those phrases. And this way we try to capture really the best of both worlds by using terms that actual customers and normal people understand, while providing the specificity as to what those terms actually mean. You may also notice that we did follow the NAIC model in permitting ACH credit transfers in our model. This is despite the fact that some of the risks of there are risks of reversal for several days, as I discussed earlier. One of the reasons that we did choose this path is because our own industry regulators have adopted and recommended it. Another reason is that there really could be beneficial uses of ACH, but escrow agents should be aware of the risks involved, which is one of the reasons that we covered ACH in such detail on this webinar and in our FAQs. I guess a good analogy is really with checks. That can be useful for real estate transactions, or maybe certain parts of it, of a real estate transaction, like for the earnest money deposit, but there are also risks, and escrow agents and title agents should only accept them on understanding the risks involved. On this slide, you can see how we handled checks in the bracketed language Michael talked about. In the first category of checks, these are those that are given next day availability under Reg CC, like cashier's checks or certified checks. These are broadly treated as cash equivalents, provided that they're authentic and authorized and that the payer's bank is solvent. The second category is all other checks, or any other check, for which we recommend either a dollar limit and reasonable grounds for believing that the check is properly payable, or waiting a long enough period of time, at least for the payer's bank's midnight deadline to run. But as Michael pointed out earlier, these conditions are not magic bullets, and many states may choose different approaches to handling checks. Mickey, I'm going to pass it over to you.
Thanks, Chris. The definition of good funds is the first major checklist to follow our model. You should only close and disperse a transaction if the funds you've received are in a form included in that definition. In section 3 of the model, we have the rest of the checklist. These are the basic conditions which, if followed, give an escrow agent a high degree of confidence that they will have safeguarded the escrow process and face minimal risk of payment reversal. The first condition is that the payment must actually be deposited or received by your bank. You can't simply have a stack of cash or checks on your desk and disperse funds from your account. You need to make sure that the funds are deposited in your account first. Second, your escrow ledger must be in balance. In other words, your scheduled disbursement must not exceed what you have received or deposited, so you don't have an escrow shortfall. And then finally, besides being on the approved good funds list, the payment must also have been made available by your bank for use or withdrawal. In other words, if you're dispersing funds from your account before they are available for use, then you might have spent other clients' funds instead of funds for the specific transaction in question. You will notice that all of these conditions are objectively verifiable by the escrow agent. We strove to avoid creating any definitions or conditions that were ambiguous or that required knowledge of internal banking processes. There we go. And that completes a summary of the Model Act and our webinar. Thank you for participating. I see that we're like literally with a minute to spare. So on the screen is a list of resources and final products from our Good Funds project, where you can find them online on the ALTA website, and I believe they're also attached. And last thing is one of the big takeaways from this meeting would be that there's a lot of information here. And these are the types of topics that you may not have a lot of information on. So luckily, ALTA has done the research and the work for you and is making this available to you. So be sure to visit the ALTA website and review the provided information. Jeremy?
All right, thank you, Mickey. We technically started like a minute or 2 minutes after the top of the hour, so we're still good. As Mickey said, there's the link to the resources. The link is posted in the chat box. Any of you who need the CE/CLE credit, the link is there as well. So please grab that before we close up. If you guys don't mind, just maybe we'll take a minute or so to address a couple of questions that have come in. the theme here is around good funds. That was what the questions are about. Ross asked about the model law and how does it get around the fact that 98% of banks no longer carry indemnity bonds on their cashier's checks. These are now essentially just another form of regular business check. Is that kind of, what you think as well, or what about that question?
The cashier's check, checks generally are a big problem, as we discussed. A cashier's check, let's sort of basics. Why is a cashier's check treated in many contexts as a cash equivalent? Under, for example, Articles 3 and 4, if you give a cashier's check, it constitutes immediate discharge of an underlying debt for which it's paid. The only remaining enforceable obligation is the check itself, which of course has to clear. We see this in Reg CC, for example. They're given next day availability if deposited over the counter, just like cash. That's because if a bank has signed a cashier's check, the bank is liable under Article 3 as a signatory on the check. And so in theory, you can rely upon the bank's credit, the creditworthiness of the bank having signed. The problem with cashier's checks are twofold. One is, well, the bank may be insolvent, as we've seen in the last year or so. There are some banks that have gone insolvent. The second reason is, well, that check may not be authentic. It could either be completely forged or it could be altered in some way, in which case, if it were altered, the cashier's check is only properly payable as it was originally drawn. And so there are real risks associated with cashier's checks, even cashier's checks. And you should only accept them perhaps if you have a reasonable basis for accepting them. But of course, they're ubiquitous in real estate transactions. And some of these risks you just simply can't scrub out via model legislation. And so, yeah, it's a great question and one for which, unfortunately, there's no great answer to.
Great answer, though. I liked what you said earlier. Good enough funds. Is that what the reference was? One more question on we'll tackle here on ACHs, and Rachel's question from Rachel. She was always told previously at other companies that ACH was not acceptable. Are you saying we can accept ACH if we choose to? She says she thinks she'll keep the ACH block on their account, but just want to make sure what she's understanding. So if you could maybe talk about the risk of ACH a little bit.
Sure. And one thing to be clear, this is a model legislation that we created for states to adopt and to consider. If your state has an existing good funds law, that's what should be followed. It may or may not address ACH depending on what state you're in. And even if ACH is permitted under the model law, certainly companies can choose to decline to accept ACH payments if that's what they so choose. So that, none of this may change your company's position. But as far as the model law and accepting, we really, using the legal research, we're able to get comfortable with a limited form of ACH, and that is ACH, the credit transfers that we would be willing to add to our model. And as I mentioned earlier, part of the basis for this was that the NAIC model, which was created by the insurance regulators, already authorizes ACH credit transfers. And so we wanted to be consistent there. And we also recognize that there could be a lot of valid uses for it, but we do, it's not a be all end all. I would caution you to use it with caution and make sure that you're following appropriate standard or safeguards that you need to and that your company or bank would require.
All right, yeah, thank you, Chris.
Get appropriate advice before using any of these payment rails. Absolutely.
Yes.
Absolutely. All right. Well, again, thank you for all of your great work on this, the analysis on the good funds and the model law. So thank you for your efforts in this. And, as we're kind of over maybe at halftime, I don't know, we still have a whole lot to go and work on the model law, but then, get states to look at it and pass it. So a lot of work here. Please check out the resources that are available on ALTA's website. Again, if we didn't get to your question, the contact email is there on that last slide. I do need to thank Qualia once again for sponsoring today's webinar. And with that, that will bring us to the conclusion of today's presentation. Thank you again all for sharing your knowledge on payment rails and the good funds laws. Take care, everyone.